Welcome back to the ROI channel, the channel that is obsessed with all things to do with the art and science of return on investment. And to celebrate coming up on 100 subscribers, I am doing the part 2 of the requested video for the offshore oil rig and tanker sector overview, if you want to call it that. If you haven't already liked and subscribed to the channel, I would greatly appreciate you just hitting the like and subscribe button. And let's begin. So I'm hugely bullish on the offshore oil rig sector. I think it's probably maybe my number one play. It's certainly in my top 3. Okay, maybe I'll do a video on my top 3 sectors for the next decade. But anyway, this is an offshore rig if you have never heard of it or seen one. Okay, so you're out in the middle of the ocean and you're on this floating thing, rig, if you call it that, and you drill down and you get that oil production from drilling into the deep sea earth where the oil is. Okay, 25% of the emissions generated by the on-land oil production, I believe. So if that's important to you, then it seems to be another bullish function for the oil rigs. And I'm going to go through today the way that I'm looking at the sector and the way that I'm choosing to play it. I'm hugely bullish on this sector. Anyway, supply. So I like to start with the supply side of the equation. Okay, I'm a big fan of Jim Rogers, and so reading his books and listening to him, I personally find it easier to start with supply, and I believe Jim does too. So that's the way that we operate. Number of companies, that's what we want to know. So number of companies, number of rigs, and what is the trend. Okay, so that will give us the overall supply into the market. And there are really only 3 players in this market. Okay, and I believe one of them's gone bankrupt. I don't know if Valaris is going to make a comeback. Noble Energy has just relisted, but really, whenever you're in a race with 3 competitors, the chances of you winning are pretty good. If you're going to bet on a horse race and you only got 3 horses upon which to bet, you would rather bet on, you'd rather take that bet than as opposed to a race with 300 horses in it. Okay, number of rigs out there, and what is the trend? Is the supply increasing? Is it decreasing? And what is the rate at which it's increasing or decreasing? So a bit of calculus, which I'm sure you're all excited about. So here are the companies, okay? Going back pre-2014, the big bull market, oil, well over $100, 2014, 2015. Look at how many horses are in the race over here, okay? And then what happens is companies start to consolidate, okay? So they use a lot of debt financing, they go on a merger and acquisition binge. And so over time, if we look through to today, you've really only got those 3, maybe 4, depending on what happens with Valaris. Okay, so if they're out of the race, it's 3. If they're in the race, it's 4. Valaris, Transocean, which is my personal favorite of the sector, Bore Drilling, and Noble Energy, which went bankrupt, they restructured, and now they have relisted. So, I mean, huge tightening of the supply in terms of the competitors. Supply of the rigs themselves. Okay, so let me get out of the way there. Offshore rig competitive utilization increased from its low point of 64% last year and is on track to hit a high of 80% by January 2022. 80% by January 2022. That's huge. Okay, look at the number of rigs during the bull market. So January 2014, follow my cursor down here, and it stands to reason if oil's the hot thing and everyone wants to get involved, there are going to be more rig manufactured and more companies offering to lease out their rig to oil producers. Okay, and as you'll see, as we go through, we had a bit of a drop in the oil price, and it stands to reason that there's less demand for the rigs. Simple as that. Okay, so the supply drops, and if you look here from 2020, obviously due to COVID and the oil futures going negative and nobody wanting to hear about oil, it's just dropped off a cliff. I mean, it's insane. So supply has tightened so much that the day rates have been reaching over 280,000 per day for use with MPD and 260,000 per day without it. Okay, so you don't need to know that. What you need to know is that there aren't enough available rigs now. So we've got demand coming back online and the supply in the rigs is dropping, and so that starts to be the equivalent of if you own a hotel, for example, and you had all these hotels, and then you went through bad times and all your competitors went bankrupt, and then you have COVID, so there's no tourists wanting to stay in your hotel. Then all of a sudden, people are allowed to travel again, and all of a sudden you're starting to go from 64%, utilization rate, or the opposite of vacancy rate, and you come back up to 80%. And when you're at 100%, your room charges, you're going to have to put them up because you've got no more capacity to take on the tourists. Same kind of thing when it comes to the rig market. Okay, you're just renting out your rigs. Trend. Okay, so the tightening rig supply is continuing. Okay, if we look over the last decade, this line here represents the rig attrition. Okay, if you don't know what that means, it's just the amount that is coming offline. Okay, so this is the inverse to the available supply. So as this line increases, flip it upside down and you get an opposing or inverse decrease in the amount of rigs that are available for operation. Okay, again, it's all pointing in the direction of a tightening supply market for the rigs. Okay, we've talked about supply. Now we want to know about demand. Okay, supply is no good if no one wants your stuff, right? So the demand side of the equation will always revolve around the commodity. In this case, we're talking about oil. If no one wants to know about oil and no one uses it, no one cares about it, no one's going to want to rent your drill rig and pull up the oil and then cart it off to refinery, right? So the oil price has gone on an absolute mission over the last sort of 9 months or so. If you've been following the portfolio, you know we've done very well out of that. And what happens is the oil price stimulates more demand for rigs, okay? So the number of rigs being rented, or the utilization rate, goes up. And once you get to a tipping point where most of your rigs are already being rented and more oil companies want to rent the rig to increase their production, you say, okay, well, I've only got a couple left, so you start to create a bit of a bidding war, and so your day rates start to increase. And as your day rates increase, obviously, your profits increase alongside with it. So pretty simple when I put it into that perspective. Again, think about the hotel example, okay? If you've got lots of tourists wanting to come in, that stimulates the renting out of your rooms. So if you go from only having 20% of your rooms rented up to 90%, obviously you can start to charge more, okay, due to the supply demand. And then as you start to charge more per room rented, your profits as the hotelier increase, okay? Super simple. Now, let's take a look. Worldwide submersibles, okay, the average day rates, and contracted utilization. This is a very, very exciting chart. This is why I'm slurring my words almost, because what this means gets me incredibly excited for the next few years. So if we go back to the bull market, okay, ask yourself, what were things like when oil was over $100 a barrel? Okay, so if we look at the dependent variable here we've got our day rates. So this gray bar, okay, represents the day rates in thousands of US dollars. Okay, so this is what you're charging to rent your rig per day in thousands of US dollars. So when oil is high, okay, you are charging around $400,000 a day to rent out your rig. Okay, so that would be an EBITDA for most companies of around about $200,000 to $250,000 a day. Okay, so earnings before interest, tax, depreciation, amortization. So you are making a lot of money on a daily basis. As you can see here, obviously the green line represents the utilization rate. So as you see, we're coming up to peak capacity to be able to supply the rigs. So you've nearly got 100%. I would say that's about 90%. If you look over here, there's a scale of 0 to 100% of utilization rate. I'd say it's about 90% of the rigs were already occupied and being used, and that's why you had such high day rates that you could charge. Okay. Then if we come down here, and the oil price has really fallen off a cliff, and obviously no one wants to rent your rigs, so you're having trouble renting them out, and you have to drop your price. So you're well below your break-even rate if you're charging $100,000, $150,000 a day. Okay, most rigs, their break-even rate would be at least $200,000 a day. Okay, so once we get to here, okay, which we haven't even got there yet, we haven't even got to the break-even rate, it's all upside. Okay, it's basically all dropping to the bottom line, and that's why I'm very, very excited about because where I believe oil is going, I know what that means for the service sector, such as the rig market. And utilization rates, let's have a look. So July this year, this is projecting it out for another year into the middle of 2022. Okay, so we are here in October, and the utilization rate, if you follow the curve, is going to go from around about 80% where we are now to about 85% over the next year. Okay, and we're getting super close to that 90% region where you saw the day rates would be more than double where they are from now. Okay, so huge potential if you look at the I suppose the mesoeconomics and macroeconomics of the situation of the sector. Alrighty, so again, another chart just predicting the day rates. So taking everything into account that we've spoken about up to this point, what do we think the day rates are going to be like moving into the future? Are the day rates going to be above the operational expenses for the company? And I think if we can get past this level, okay, the 200,000 a day, we are making a lot of money on a daily basis. So that's it. If you haven't already liked and subscribed, would appreciate you doing so. I would highly recommend you go and watch the other videos I've done on Transocean in particular, and also Scorpio tankers. They're the two that play in this oil services sector. And if you haven't already checked out the portfolio, click on the link, add it to your watch list, or if you've got funds and you want to start sharing the gains, you can, for a minimum I think of $200, you can elect to copy the portfolio. That will sync your $200 with all the positions that we have, and then you'll be able to compound it and grow your wealth with me doing all the work. Thanks very much for watching. As always, disclaimer, make sure you take responsibility for your own investment decisions. None of this is advice. I'm not a financial advisor, thank goodness, and you really need to utilize discipline and discretion in everything that you do when it comes to investment decision making. Okay, you're responsible for your decisions and your actions. Having said that, I hope you enjoyed the video. Thanks for all the support that I've gotten so far. It's been amazing, and I really do appreciate it, and I look forward to be able to continue to provide valuable content. And so if you've got anything that is on your mind, whack it in the comment section, and eventually I'll get around to doing something about it. Thanks very much for your support, guys. Have a great day, and I'll see you next time with another video.